Good afternoon, ladies and gentlemen, and welcome to this briefing on the economic and fiscal outlook that we've published today alongside Chancellor Rishi Sunak's first budget. This sets out five-year forecasts for the economy and the public finances and an assessment of the government's progress against its fiscal rules. The judgments are those of the OBR's Independent Budget Responsibility Committee, but we have, of course, benefited hugely from the hard work and expertise not only of our own staff, but of officials across a wide range of departments and agencies to whom we're very grateful. Needless to say, these are very unusual circumstances in which to be launching an EFO. As normal, the Treasury asked us to close our pre-measures forecasts for the economy and the public finances some weeks ahead of the budget, in mid-February, to provide them with a stable baseline against which to prepare their policy decisions. When we did so, the coronavirus looked likely to be contained largely within China and to imply only a modestly weaker outlook for world trade and UK export markets. Clearly, the position now is very different. In addition to having profound consequences for public health and families' well-being, the spread and severity of the virus is now expected to have significant consequences for the economy and the public finances, at least in the near term, and asset markets have responded accordingly. This, in turn, has triggered a policy response. The Bank of England has taken action this morning, and the budget announced a further £12 billion fiscal package to support the economy and protect vulnerable individuals and businesses. These, of course, came too late to reflect in the figures that we present here. As a result of all this, the forecast presented in this EFO can obviously no longer be treated as central. The downside risks are all too clear. But even if we were starting now with a blank sheet of paper, their scale and duration would be impossible to quantify with any confidence. But there is still some value in the exercise. As we shall see, the government has announced a new set of fiscal objectives and the largest giveaway budget for almost 30 years for reasons that have nothing to do with coronavirus. Assessing the impacts that this might have over the medium term remains worthwhile, even if the near-term outlook is worse and more uncertain than the forecasts assume. So let me start with the big fiscal picture. This chart shows our March 2019 forecast for the budget deficit, which we restated in December to reflect statistical changes, notably an improved accounting treatment for student loans and a corrected treatment of corporation tax. As you can see, the deficit was forecast to rise slightly to £47.6 billion this year, and then decline steadily to just over £33 billion by 2023-24. Our pre-measures pre-coronavirus forecast was slightly worse by about £3 billion a year on average. But most of the action comes from the budget, tax and spending measures and other policy decisions, which by the end of the forecast add almost another £30 billion to the deficit. Over the forecast as a whole, they increase net debt by no less than £125 billion. As regards the pre-measures forecast, as far as the economy is concerned, we assume that the UK makes a smooth transition to a typical free trade agreement, as we have no way of knowing exactly where the current negotiations will end up. As best we can tell, potential output is around 2% smaller now than it would have been in the absence of the referendum vote, largely reflecting lower inward migration and weaker productivity, the latter thanks in particular to depressed business investment. Drawing on several external studies, we assume that the move to an FTA will lower potential productivity and potential GDP by about 4% over the long term, again relative to where it would otherwise have been. We estimate that a third of that can be seen in the data already, a third will come over this five-year forecast period, and the remaining third thereafter. As time goes by, business investment should pick up as uncertainty recedes, and trade barriers and trade frictions and barriers to specialisation will take over as the main factors holding productivity back. Even before the coronavirus came on the scene, world GDP and trade growth were being depressed by trade tensions, and we did make some modest early adjustment for coronavirus based on the experience of SARS. In the UK, the outlook for real GDP growth looked somewhat weaker than a year ago. Recent outturn data certainly pointed to a lower calendar year growth rate for 2020, and over the medium term we saw a weaker outlook for productivity growth, outweighing better news on labour market participation. So cumulative GDP growth also looked weaker overall than a year ago. Consistent with this, financial markets expected lower interest rates than they did last March. The fall in interest rate expectations, together with lower RPI inflation, lowered debt interest spending by £7.4 billion a year on average. But this is more than offset by weaker tax receipts, thanks to a weaker household incomes and spending and higher government spending. The latter includes more capital spending by local authorities, higher capital transfers related to student loans, more use of R&D tax credits, and greater expected spending on incapacity benefits than we thought previously. Hence the £3 billion average rise in borrowing pre-measures that we saw in the chart. So now let me turn to the impact of the policy measures that we've seen since last March, but before the effect of today's £12 billion response to the coronavirus outbreak. There are three main changes that we needed to reflect. First, the budget package, which builds on the 2021 spending round announced last autumn. As we shall see, this includes big increases in current and capital spending plans, partly paid for by net tax increases and the direct Brexit savings that we've included in previous forecasts. But most of the extra spending is financed simply by borrowing more. Second, the new migration regime, which is tighter for EU immigrants and marginally less so for non-EU immigrants than what we have now. And third, the plan to increase the national living wage to 2/3 of relevant median earnings by October 2024. So let's see how these affect borrowing and contribute to that much bigger upward revision to the deficit from policy than from the underlying forecast that we saw in the chart. The biggest items are the new and much higher limits on resource and capital spending that will underpin the government's comprehensive spending review later this year, unless they're further revised. Their direct impact is to increase borrowing by more than £55 billion a year by 2024-25. To put this in context, this chart shows successive plans for resource spending, in other words, day-to-day spending on public services, grants and administration, per head of population and adjusted for inflation. It shows that the Conservative governments since 2015 have already significantly reined back the planned cuts inherited from the coalition, and the latest plans would reverse all the cuts since 2010 by 2024-25, and half of them over just 2 years. All this is true in aggregate, but of course some parts of the public services would fare differently from others. Viewed as a share of GDP, we end up with around about 1/3 of those cuts being reversed. Looking at capital spending on the same share of GDP measure, you can see that the sharp cuts over the first 2 years of the coalition, which had been a feature of the previous Labour government's budget in March 2010, were already being rolled back and would almost certainly have been reversed by the plans on which our last forecast was based a year ago. The new budget plans will lift capital spending significantly above its 2010 level as a share of GDP. It's important to point out that when judging the impact that higher capital spending limits might have on the deficit, we generally assume that departments will not spend fully up to those limits, especially when they're being ramped up relatively quickly. As you can see here, capital spending outturns have fallen short of plans in most recent spending reviews, except when they've been overtaken by explicit decisions to loosen fiscal policy again. In this forecast, we assume that 20% of the increase in capital spending limits that was announced in this budget does not in fact get spent. Returning to the impact of the policy changes, we see that the rise in the spending limits is partly offset by direct savings from Brexit. Our post-referendum forecasts have all assumed that any direct savings from the contributions that the UK makes to the EU budget, plus any extra proceeds from customs duties, would be recycled into domestic spending rather than used to reduce borrowing. Now that the UK has left the EU and that spending plans have been set for the next few years, we can remove this del in waiting from the forecast. This reduces the impact of the new spending plans on borrowing by £4.3 billion next year, rising to £14.6 billion in 2024-25 as the divorce bill instalments shrink in size. In addition to higher spending, the budget announced higher taxes. The blue bars show the gross tax increases at the bottom outweighing the gross tax cuts at the top to reduce borrowing by £8.5 billion by 2024-25. This table shows the main moving parts. The biggest tax increase is the decision to cancel this year's planned cut in the main rate of corporation tax from 19% to 17% that George Osborne announced in his final budget. Other increases include a reduction in the lifetime capital gains eligible for entrepreneurs relief and a restriction on the use of red diesel relief. The biggest tax cuts are an increase in the national insurance threshold, a series of business tax cuts, and that old chestnut, a one-year freeze in fuel duty rates. Thanks largely to policy measures and real earnings growth pulling more income into higher tax brackets, tax revenues rise as a share of GDP over this forecast. National accounts taxes reach their highest share of GDP since 1969-70, and the broader measure of total receipts reaches its highest level since 1984-85. Taking only the direct effect of all these measures into account, the increase in the budget deficit would reach more than £36 billion by the end of the forecast. But this is partly offset by their indirect effect via the economy. The fiscal giveaway gives a temporary cyclical boost to GDP growth, as well as pushing whole economy prices permanently higher. Higher incomes also increase house prices in the near term, and all this boosts tax receipts. Over the longer term, we might expect the increase in public sector investment, especially in areas like transport infrastructure, to boost potential GDP. Indeed, if the increase in general government investment announced in this budget were to be sustained indefinitely, which history admittedly suggests is unlikely, then this could increase the potential size of the economy by around 2.5%. But little of this would show up within our 5-year forecast horizon. In addition to its economic impact, higher resource spending is also partially self-financing, in the short term at least, because around 1/10 of the money comes back to the Exchequer in the form of higher pension contributions. Taken together, these two effects reduce the deficit, as you can see here, by £7 billion in 24-25. Two other policy changes have much smaller and, by coincidence, largely offsetting indirect effects on the deficit, namely the new migration regime and the planned increase in the national living wage. The new points-based migration criteria that the government will introduce in 2021 are more restrictive for EU migrants and marginally less so for non-EU migrants than what we have now. We expect this to reduce net inward migration overall, particularly for low-wage and therefore mostly low-productivity workers. As a result, we now base our forecasts on the ONS's zero net EU migration population projection rather than their principal population projection, even though we would not actually expect precisely zero net migration from the EU. This puts net inward migration in 24-25 at 129,000 instead of 190,000. A smaller population and a slightly lower participation rate reduce employment by 0.4% by 2024-25, but average productivity across the smaller workforce is 0.1% higher. This leaves real GDP 0.3% lower, but real GDP per head little affected, as the effects on the participation rate and productivity broadly offset each other. Lower tax receipts outweigh lower welfare payments to leave borrowing a negligible £1 billion higher 5 years from now. One caveat here, delivering the new migration regime on time clearly looks quite challenging. Turning to the living wage, increasing the target to 2/3 of relevant median earnings will raise it to a level above that in most other countries, and that makes the potential impact harder to judge. But we have assumed that in addition to directly increasing the wages of people below the new path for the NLW, the impact will spill over to people with wages up to 40% higher than that. We estimate that this will reduce total hours worked by 0.3%, including a modest rise in unemployment of about 50,000, and lower real GDP by 0.1% by 2024-25. The expected change in the wage distribution, shown here, boosts income tax receipts but squeezes tax on profits. Welfare spending is little affected, with the means-tested bits lower, but the triple lock pushing state pension spending higher. In aggregate, borrowing is a little over £1 billion lower 5 years ahead. So where do these effects leave our post-measures economy forecast? Bear in mind, once again, that like the pre-measures forecast upon which it is based, the post-measures forecast does not reflect the recent news on the spread of coronavirus or the policy response from the Bank and the Treasury, and thus looks too optimistic in the near term at least. This chart shows our GDP forecast from a year ago and the new pre-measures forecast slightly weaker over the next 5 years, especially in 2020. As the impact of the policy measures, and you can see that the fiscal loosening gives the economy a bit of a sugar rush in 2021, but the other policy changes leave growth slightly weaker on average over the full 5 years. Turning to prices, we see that CPI inflation has been lower over the past year than we'd forecast, and we expect it to remain lower than forecast for much of the next 5 years, in part because of less rapid increases in energy prices. Excise duty freezes help push inflation a little lower this year, but the fiscal expansion pushes it up to a target earlier than our pre-measures forecast and at a similar point to where we forecast a year ago. In addition to their effect on GDP growth in aggregate, the policy measures affect the composition of GDP. This chart shows the cumulative change in real GDP between the pre- and post-measures forecasts. As you can see, GDP increases slightly less overall than a year ago, thanks mostly to the lower inward migration. And the increases in planned government spending crowd out consumer spending, private investment, and net trade in roughly equal measure. We can see this crowding out in the labour market too. We expect whole economy employment to rise by 520,000 over the next 5 years, rather than by 720,000 pre-measures, thanks largely to less inward migration. And we expect general government employment to account for 490,000 of this increase, rather than 350,000 pre-measures. That would be sufficient to reverse the entire fall in general government employment that we've seen since 2010. Turning back to the budget policy package in aggregate, how does it look in historical context? This slide shows some of the largest fiscal giveaways and takeaways of the last 30 years as shares of GDP, the impact on borrowing in each year. As you can see, this looks like the biggest sustained giveaway since Norman Lamont's ill-fated pre-election budget in March 1992, when official forecasts, as you can see, didn't extend as far as they do these days. In fact, this had to be reversed within months after sterling left the European exchange rate mechanism in September that year. The fiscal stimulus implemented in response to the financial crisis in November 2008 and March 2009 combined was larger than this budget to begin with, but soon moved to the promise of a large fiscal consolidation to reflect the weaker output for potential GDP and to reduce the resulting structural budget deficit. In some ways, the closest comparator looks like Gordon Brown's 2000 budget, when the Labour government turned on the spending taps after initially sticking to the cuts that it had inherited from the Conservatives in 1997. They did so in the expectation that tax receipts would remain strong, but they were then dented by the bursting of the dot-com bubble, and they never rebounded as strongly as Labour had hoped. This budget can also be seen as part of a broader shift in fiscal approach between the coalition years and what has followed. As you can see here, the measures announced by Conservative governments since 2015, and especially in the wake of the EU referendum, would reverse around a third of the consolidation undertaken by the coalition, measured by the expected impact of policy measures as a share of GDP. As well as looking at the impact of policy decisions on the deficit, we can also look at the stock of public sector net debt. This chart shows that by the end of the forecast, the direct effect of the budget measures is to increase net debt by just under £150 billion, thanks to higher cumulative borrowing. Asset sale delays and cancellations increase it by a further £12 billion, mostly because the government has decided not to continue selling student loan debt, now that this no longer flatters the public finances under the improved accounting treatment. The indirect effects of the policy measures reduce borrowing, as we've seen, and thus they lower net debt by £36 billion by the end of the forecast. So the overall impact is to raise net debt by £125 billion, or 4.6% of GDP. This is sufficient to take the cash total above £2 trillion for the first time. It's more meaningful, though, to look at net debt as a share of GDP. And we can also look at other balance sheet measures that either reduce the short-term effects of the Bank of England's term funding scheme or which include a wider range of assets and liabilities. As you can see, both net debt measures broadly stabilise at around 75% of GDP, rather than falling as they did last March. Public sector net financial liabilities do fall slightly, as assets not included in net debt, such as student loans and those of funded pension schemes, rise in value. But even PSNUFL remains far above its pre-crisis levels. So how would the government perform against its fiscal rules if the public finances were to evolve in line with these forecasts? The current formal targets are those that Parliament approved in the latest Charter for Budget Responsibility in January 2017. But the Chancellor wrote to us ahead of the budget to say that his decisions would instead be guided by the looser rules set out in the Conservative manifesto and confirmed in the Queen's speech. These will be reviewed again ahead of the next budget, as the Chancellor said, which suggests that they may not offer a good guide to future policy decisions. Of the targets still in legislation, the government is now on course to miss two of them, the fiscal mandate and the fiscal objective. The fiscal mandate requires cyclically adjusted public sector net borrowing to lie below 2% of GDP in 2021. In our original March 2019 forecast, this was on course to be met with around £26 billion to spare, but the statistical restatement in December reduced this to £7.6 billion. On the pre-measures forecast for this budget, the margin was smaller again at £5.3 billion, but this has now been more than exhausted by the fiscal giveaway, and the target ends up being breached by £9.2 billion, or 0.4% of GDP. The government's legislated fiscal objective, which was being downplayed even before the election, is to balance the budget by the mid-2020s. As this chart shows, just 18 months ago in our October 2018 pre-measures forecast, the government was on course to achieve this ahead of schedule in 2023-24, but it's now aiming to run a deficit of around 2% of GDP into the medium term. Why the turnaround from a potential surplus of £3.5 billion in 23-24 to a deficit of £60 billion? The government's policy changes have made most of the difference, adding £50 billion to the deficit. The statistical improvements have also contributed, while underlying forecast revisions have provided a modest offset. So what are the government's new targets, announced in December but already up for review? In addition to the reset welfare spending cap, there are three new targets for the public finances. To keep the current budget balance, which excludes borrowing to finance net investment spending, in surplus 3 years ahead. To ensure that public sector net investment doesn't exceed 3% of GDP on average over the forecast period. This puts a ceiling on total borrowing. And to ensure that the debt to GDP ratio is falling if the ratio of debt interest to revenue exceeds 6% over a sustained period. Not surprisingly, the government has set policy in the budget to meet them all. Starting with the first of these, you can see that the current budget had already returned to surplus in 2018-19, the deficit having peaked at over 7% of GDP in 2009-10. Our pre-measures forecast shows the balance continuing to improve, albeit more slowly than over the past decade. Add on the budget and other policy measures, and you can see that it remains in surplus, but with less margin for error. The rule is met in 2022-3 with £11.7 billion to spare. Turning to the maximum investment rule, we can see here that the government spending plans would deliver public sector net investment averaging 2.9% of GDP over the 5 years of the forecast, thereby meeting the rule. As the chart shows, this is a relatively high level of investment by past standards, at least back to the 1970s, when we had more nationalised industries and much more public sector house building. Ironically, if the government were to succeed in spending right up to the departmental limits that it proposes for the spending review, the rule would be breached. There are, of course, different elements within public sector net investment. Net fixed capital formation, which is what most people would think of as capital spending, namely the building or purchasing of fixed assets for the public sector like roads or buildings, only accounts for a little under half the total. The remainder consists largely of capital grants, some of which finance fixed assets in the private sector, such as social housing, but others do not. For example, the upfront recognition of student loan write-offs. The third target, or trigger, is to take action to reduce the debt to GDP ratio if net interest payments exceed 6% of non-interest revenues for a sustained period. This chart shows that the ratio is expected to drop from 3.8% in 2019-20 to 2.9% in 2024-25, so this trigger isn't pulled. As you can see, the ratio exceeded 6% consistently up to 1991, reflecting relatively high borrowing costs and initially the remainder of the still high post-war debt burden. But it has exceeded 6% only twice in the past decade, thanks to spikes in RPI inflation in 2010-11 and 11-12. The Conservative manifesto said that pursuing the new fiscal rules means that debt will be lower at the end of the Parliament, at least as a share of GDP. And as we saw at a moment, that's forecast to be the case, but only because of the repayment of term funding scheme loans. It's worth noting that the new rules would not in themselves guarantee that the debt to GDP ratio falls in normal times. Its path depends not just on borrowing, but also on financial transactions and the growth of nominal GDP. The new rules put an effective ceiling on public sector net borrowing of 3% of GDP, but over the medium term, the deficit would need to be closer to 2.5%, even to keep the debt ratio falling very slowly. Needless to say, and as we always emphasise, the outlook for the public finances is always uncertain. Leaving aside the unusual current situation and looking purely at past forecast performance, this chart shows that the government has around a 60% chance of meeting the new rules, compared to around 70% when the last ones were put in place. So the government has given itself a little less margin for error than last time. As always, the EFO discusses a large number of risks and uncertainties that lie around our central forecasts and around the government's chances of hitting its targets. But for now, of course, coronavirus is by far the most immediate and important. In addition to its expected impact on public health, it's likely to have significant consequences for the economy and the public finances, at least in the near term, if not further out. With lots of people potentially sick or limiting their movements to avoid becoming so, the virus is likely to depress both demand for goods and services and the ability of businesses at home and abroad to supply them. This will reduce tax receipts, and the government will need to spend more in areas like health. One potential offset is that the virus may make it even harder for the government to get its planned capital spending increases underway than we assume already. It's impossible to predict the scale or duration of the economic and fiscal disruption with any confidence, but it should be temporary unless it inflicts lasting damage on the economy's supply capacity, as, for example, the financial crisis did. We might therefore expect the coronavirus shock to further ratchet up the level of public sector net debt as borrowing rises temporarily, but hopefully it shouldn't increase the structural budget deficit long term. As regards the specific measures that the Chancellor has announced today, the Treasury has put a figure of £12 billion on the package, but there's obviously a lot of uncertainty around that. There's £5 billion for the NHS, which will be added to if necessary. There are measures to limit as far as possible the impact on household incomes, which is partly at the expense of government and partly at the expense of employers. And then there are measures to absorb or offset some of those costs for businesses and to make sure that temporary cash flow problems don't cause otherwise healthy companies to fail. The cost of support to households and businesses will, of course, largely depend on how many people are affected by the outbreak, which we simply can't know at present. To conclude, let me look beyond coronavirus for a minute to the big fiscal judgment that the government was making in this budget before it came along. In the immediate aftermath of the financial crisis, the coalition government focused on reducing the large structural budget deficit that emerged in the crisis, a process that would in time stabilise the debt to GDP ratio and begin to bring it down. By late 2016, Philip Hammond, as Chancellor, was easing up on austerity, but said that he still wanted to return the budget to balance and to bring the debt to GDP ratio down. The new government so far is taking a different approach, in some ways resembling that of the Labour government in the years running up to the crisis. It's trying to keep the current budget in modest surplus, but to ramp up investment spending. And in doing so, it's content to run a significant budget deficit in normal times and to stabilise the debt to GDP ratio rather than to reduce it. The case for doing so rests on the fact that it's far cheaper for governments to borrow now than it was in the mid-2000s, and financial market expectations suggest that this will remain the case for the foreseeable future. So the ratio of debt interest to GDP remains low, even if the ratio of the debt stock to GDP is relatively high. The risk, of course, is that financing conditions do not remain benign and that borrowing costs rise because of risk premia rather than simply because of a stronger outlook for economic growth. The debt to GDP ratio is now twice as high as it was pre-crisis. The government has much more index-linked debt, and the Bank of England's asset purchases have shortened the effective maturity of the debt stock. Note that even though we expect the budget deficit to be lower over the next 5 years than it was pre-crisis as a share of GDP, the amount of money that the government has to raise from the gilts market and other sources is significantly higher at around £150 billion a year. This is because it has to roll over maturing debt, in effect refinancing the consequences of the financial crisis, at the same time that it finances this new borrowing. The bottom line is that the current approach looks sustainable over the medium term on current forecasts for growth and borrowing costs, but the public finances are much more vulnerable to nasty inflation and interest rate surprises than they were. Thank you very much indeed. I'll ask my colleagues to come up here and then we'll be happy to take any questions you may have. Yes, excuse me.
Alex Morales from Bloomberg News. You've said that you now expect coronavirus to have significant consequences on the economy. Looking at page 33, I think, you seem to have factored in a 0.1 percentage point drop in growth based on the data as of February the 14th. Can you give any sense of how much further the impact would be given the current situation?
No, I mean, that's a question as much for an epidemiologist as it is for an economist, I think. As you can see, the nature of the shock is likely to be one that simultaneously hits demand, people's willingness and ability to spend on goods and services, and the ability of businesses to meet that. But knowing exactly how deep that's going to be, exactly what the duration of that is going to be, is, as I say, it's a matter for medical experts as much as it is for us. And obviously, one possibility is that you have a relatively concentrated short-term hit, but at the same time, the medical experts are obviously trying to smooth this out, which would make it a longer-lasting hit, but not as severe. I think the key point to take from the perspective of planning the public finances is that this should be a short-term hit to economic activity, and therefore something that pushes the level of public sector debt up. But there's no reason yet to believe that it will have a lasting effect on the economy's growth potential, and therefore that it would increase the size of the structural budget deficit, which is what you worry about in terms of whether you've set policy in the right place. Charlie, is there something you want to add to that?
That's good. Okay, could I just follow up, if I may, because I think you have to come up with another forecast in 3 days' time. Is that because of your
which if you are hoping it is going to answer all the questions that we haven't, I'm afraid you'll be sadly disappointed.
A significant revision in your GDP forecast for this year to be coming in 3 days' time?
No, there'll be no change in the economic forecast or the broad elements of the fiscal. As we set out in a letter, exchange of letters with the Chancellor, all we're doing with that is to, as it were, tie up some loose ends that there always are at the end of forecasts, particularly ones where you have big budget movements in terms of the outlook for debt interest. So there are no new judgments, no new policies, no new implications of coronavirus. So I'm afraid I wouldn't set your alarm early for the arrival of that. It is a legal obligation that we have to produce this. It's the Chancellor who decides, when he wants us to ask us to do this. This was all discussed prior to the coronavirus thing blowing up, and it seemed the best way to get out of a difficult decision, caused, of course, by the fact that the last forecast was cancelled for the election.
I will just add a coda to that. I mean, were we to produce a forecast that tried to update the economic outlook, by the time we published it, it would again be out of date because this is such a fast-moving situation. I mean, frankly, any forecast of the economic hit from coronavirus is sticking a finger in the air. But as Robert says, it should be temporary. And the important thing about the policy response at the moment is to make sure that there isn't a lasting hangover onto the supply side of the economy. And the measures today from both the Chancellor and the Bank of England are designed to try and minimise the chances of those longer-term supply-side consequences.
Yeah.
David Robinson, Market News. Given the size of the coronavirus package announced today, would it be reasonable to assume that at least the current budget balance rule would have been broken, would have been breached, had you known about that package? Or can you say anything in terms of that?
Bear in mind that the current budget target is a rolling 3 years ahead target. The Chancellor today, I think, was essentially talking about that money being what you would need to spend in the course of 2020 21. Obviously, this depends again back on the epidemiology of how long this goes on for. So, in that sense, it's not going to hit in the year of in which the target applies. Yes.
Hi, Kate Andrews from The Spectator. You mentioned that the potential growth boost that could come from public spending wouldn't necessarily come in the next 5 years projection. So how long would it take to come, and what is the most optimistic prospect for the government to see group growth go up in the next 5 years?
Well, in terms of the impact, the way that we've looked at this is in terms of basically thinking about the long-term view, is what would the plans that were announced today imply for the size of the public sector's capital stock into the future, and what would that then imply for potential GDP. So there's a good deal of uncertainty in those elements of calculations, deciding what the links between those two elements are. Obviously, a lot would depend on what this money actually ends up being spent on. Does it end up being spent on stuff that is actually going to have lasting improvements on potential GDP? And so these sorts of estimates are simply looking at averages that you've seen in other countries and in the past, rather than saying, well, this is the particular mix of investment that you expect that to come out with. I think when you consider, obviously, a lot of the things that you might expect to be most helpful to potential GDP of things like transport infrastructure, the amount certainly of major projects that you could get those into a state where you've not merely got shovels in the ground, but you're actually delivering a flow of capital services from those is likely to be well beyond the 5-year period. There are things, obviously, you can do in the shorter term that can be helpful, but it's really only a sensible thing to think about as where might you end up in some decades' time. The other point to bear in mind here is that we're assuming, and we'll talk about this more when we do our fiscal sustainability report in the summer, is that this is assuming that the increase in investment as a share of GDP is then sustained by future governments indefinitely over the rest of the 50-year horizon that we do it. And obviously history suggests these things go up and down, so you can't bank that either. Charlie, something you want to add on that?
I mean, the increase in public capital spending over the forecast period, taking evidence from what studies that have been done on other countries, on the UK, and a sort of average mix, a ballpark estimate for the impact on potential output of that is about 0.5 percentage point. But I would really stress the uncertainty around that. There's uncertainty both about the effectiveness of the spending, because some spending affects potential output like transport, infrastructure, other stuff like building hospitals. It's much more debatable what impact there would be. Generate lots of social returns, but not necessarily potential GDP. And then the time scale under which the enhancement to capital services in the country comes through is long, given you've got the project gestation lags. And then again, depends how the private sector responds to that. So that's why we think it's reasonable, if you like, to score the benefits to potential output from the extra public capital spending as really coming through beyond our forecast horizon.
Yeah, John.
Joel Hills from ITV News. The government is spending as the economy slows. In fact, it's growing spending at twice the pace that the economy is growing. Is that sustainable?
Well, in terms of the outlook we've got here, as I say, if you've basically got a deficit of around 2.5% of GDP, that would look consistent with keeping the debt to GDP ratio broadly stable. So, I mean, clearly at the moment there's a lot of debate about what the appropriate amount of money that governments can borrow on an ongoing basis is, and that's very much tied up with what you think the interest rate at which the government is going to be able to borrow at and the growth rate of the economy is going to be. So this is, I wouldn't say, you wouldn't describe it as a gamble, because it's consistent with market expectations that government borrowing costs are going to remain relatively low. But as we've highlighted in the fiscal risks report, and we do again here, if that changes, then the arithmetic becomes a lot more uncomfortable.
And what's your personal view? You're demob happy. You're getting ready to check out. And, speak your mind, Robert Chote. This is a gamble, isn't it? This is a massive gamble.
I'm months away from being demob happy. I'm neither demob nor happy, and won't be until October. So as I say, this is there's a lively academic debate on this area, and as long as this holds, then this is fine. If not, it becomes more uncomfortable. But there's then time to take decisions about it. Anybody want to?
Well, I mean, clearly, the more debt you build up, the more exposed you are if things go wrong. And there's a good general principle that you want to have the debt to GDP ratio declining in good times to build up the space for responding precisely to the sort of events we're seeing at the moment, like coronavirus. You've got the fiscal space to respond. If you only have the ambition to keep debt constant as a proportion of GDP, every time you get a bad shock, you just ratchet up again. Hopefully coronavirus won't be too costly, but there's financial crises and climate change financing costs to come along, lots of things like that. So you need to factor those in thinking what's a sensible long-term fiscal strategy. But it's not for us to say what the right path is.
I think it's
Merely
exactly,
to
it's
spell out the
exactly those
consequences.
questions that the Chancellor wants to look at in this review ahead of the budget next time, when I won't be here and you'll have to ask somebody else how sensible it was. So there we go. Yes.
It's Tim Wallace at the Telegraph. I had a couple of other corona-related questions that I thought you might be able to answer. One of them was about the export side of the economy. You've already got exports falling as part of your forecasts. Now we've had a little bit more time to judge the global impact of coronavirus, what it means for the Chinese economy and so on. Do you think that's going to get worse, that export's going to be hit further than you anticipated when you wrote this?
Charlie, do you want to?
Well, the main reason that exports are falling is because of the impact of the new trading arrangements with the EU. And there's a compensating thing on the import side as well. On top of that, we have a slightly higher exchange rate in the forecast, and that adds a bit extra. But the main driver here is just the increased trade frictions with the EU. Now, clearly, what happens in the rest of the world may well be layered on top of that. So if there's a very strong slowdown in the rest of the world, stronger than we have in the forecast, as is certainly likely in the short term, then that would impart a further downward impetus to exports.
And the second corona impact I was thinking of was oil prices tumbling this week, gilt yields falling quite sharply. Do those feed into your forecast when it comes to inflation, growth, government debt costs?
Yes, they will do next time we come to do that. I mean, the situation clearly at the moment is these things are moving around an awful lot from day to day. So how useful any snapshot in a particular day is. But for example, if you have lower oil prices, that goes through and has an effect on inflation. That affects the cost of index-linked debt, for example. You also have direct effects from equity prices to different sets of tax revenues, capital gains tax, inheritance tax, etc. So there are a set of channels like that from these specific asset markets and financial markets. But I think it's going to be this broader question of what sort of blow of either size and duration does this do to economic activity that's going to be at least as much more, and as Charlie says, the crucial question is whether that can be contained as a temporary hit or whether it's something that has a longer hangover that you would worry more about. Yes, Phil.
Hi, Philip Inman from The Guardian. Could you just talk a bit more about Whitehall departments, those that are affected by austerity over the last 10 years, the extent to which they'll continue to be affected by austerity outside the health and schools budgets? And also, when you talked about a sugar rush from the public finances over the next year, and then it tailing off, could you just talk a bit more about the things that are going to make it tail off?
Sure. Well, why don't I not answer the first of your questions, and I'll ask Charlie to answer the second one. In terms of the different, the different treatment of different parts of the public services, that's obviously going to depend on the spending review and the decision the Chancellor takes then. I mean, if you look at what's happened to spending over the last few years, you don't need me to tell you that there are areas like health, overseas aid, etc., that have fared relatively well compared to a lot of others. What will be interesting is now that we've got this sort of swing in that chart of the spending pattern, whether that changes the balance between what we have got used to thinking of as protected and unprotected departments. Although clearly, as we've outlined in our long-term reports, there's obviously a strong underlying pressure for health in particular, partly demographic, but more for non-demographic health costs that would lead you, I suspect, to conclude that health is unlikely to be a big loser in the future, simply because you've got those underlying pressures, not just the short-term developments.
What was the second question again?
Why does the GDP...
The sugar rush and why you
okay. I mean, the crowding out, essentially. I mean, some of that crowding out may be direct, so competition for resources in the economy. So if you think of construction, a lot more construction going on because of the public programme, only limited capacity to supply that, so that will crowd out some private investment spending directly, and residential and so forth. This is particularly in the context where the labour market is already quite tight and you're restricting immigration going forward with a new migration regime as well. So there's that. Then on top of that, there's both endogenous adjustment in the economy, because higher levels of activity will tend to put upward pressure on wages and prices. And then you would also expect a response by the Monetary Policy Committee. They're supposed to keep inflation on target, so you would expect them to be tightening monetary policy in response to the moving from, in our baseline, we basically have a small margin of spare capacity through most of the forecast period. In the post-measures forecast, the economy is running above capacity, peak about 0.5% of GDP. So that excess demand, you would expect to lead the MPC to have higher interest rates. And actually what we do have, Robert didn't mention it in his introductory remarks, but we have a different interest rate profile in the pre-measures forecast and the post-measures forecast to allow for that financial crowding out. Also the exchange rate is a bit higher as well, so some of the crowding out comes through trade. And if you're thinking, what are the elements of expenditure which are crowded out to make room for the extra government spending, it's about a third consumption, a third private investment, and a third net exports.
Okay, yes.
It's Matt Dathan from The Sun. You say there's a 60% chance of meeting balancing the books by 22-23, but the odds are likely to be worse because of coronavirus. Can you be a bit more specific? Is it less than 50-50?
No, we can't really. I mean, this again comes back to this question of how long this hit to the economy and the resulting increase in the deficit goes on. The longer the medical difficulties go on, the longer the impact on the economy is likely to go on. But at this stage, it's impossible to predict how likely that is. And as I say, the key point in terms of the policy measures, as we discussed earlier, is that those are mostly in 2021, and hopefully most of the economic costs might be as well there, but it could spread on longer, even if it's not a permanent hit in the longer term. So, you would clearly assume that it would be, lower than 60, more likely to be lower than higher, but you wouldn't want to say how far. Yep.
Thank you, Rob. Merrick from The Independent. So I see you're not modelling the impact of the Prime Minister's intended Brexit deal on GDP, but you are on productivity and talking about a hit there. I think I'm just looking at where you talk about the sort of long-term effect on a lower trade intensity, loss of a comparative advantage, less efficient international distribution of production. You talk about a long lag period, I think, for the UK economy over maybe 15 years or something. Can you give us a little bit more detail about the costs that you see there to the makeup of the UK economy?
Well, we are looking at productivity and GDP as well. It's all taken into the round. What we're not doing is looking specifically at the impact of a particular expected outcome for the negotiations. What we're basically saying is, look, as we don't know where this is going to end up in the negotiations here. We are assuming, one, that there is a smooth movement to whatever follows rather than a disruptive exit. And the second thing is that we're basically assuming a typical free trade agreement, not some specific, bespoke model. the sorts of judgments that we've made there about, the fact that you would say, as you say, have about a 4% hit to productivity overall, which would then feed through to potential GDP. Less inward migration, which again also would feed through to potential GDP. But there's a good deal of uncertainty around those elements. Now, in terms of the nature of the hit, the hit that we've had so far since the referendum is dominated more by lower migration and the fact that business investment has been weak, and that has meant that there's been less deepening of the capital stock, so the hit has come more from that. Once the deal is hopefully done, that should take some uncertainty away, should encourage businesses to invest more, but at the same time you then actually confront the trade frictions themselves and the barriers to more effective specialisation of the economy. So as the drag from business investment goes away, the drag from those things comes in to replace it. And as I say, we're using by coincidence a third quite a lot here. It's a third's happened already on potential productivity, a third over this 5 years and a third beyond that. But there's huge uncertainty both around the overall magnitude and around exactly how long it takes.
So you're not saying you're not pointing to any particular part of the economy being particularly affected?
No, we don't do sectoral industry by industry stuff. The Whitehall study, the government study, has looked at that in more detail, but obviously because we're focused on the public finances, we tend to look at it as an aggregate level. Okay, well, thank you very much indeed. We look forward to seeing you hopefully at the Fiscal Sustainability Report in the summer, and then whenever you are gathered here again next for a budget or autumn statement. Thank you very much.